Okay, so making this video for the lecture for money, banking, and financial markets, topic 6 slideshow. I'll walk you through the note taking and quizzes. I'm not sure how far we're going to get, and I haven't made the video. Once I make the video will be the second choice. I will also have it hot linked. I think we'll put it in two places. It'll be about in the first subtitle 6.1 roll of money, and we'll put it on the note-taking sheet on 6.1 too. When you see that highlighted in blue, that'll be why. Okay, with that said, let me walk through the slideshow. Let's get started. Okay, so the whole slideshow is going to cover the whole topic for money, banking, and financial markets. It's going to cover role of money, changes in the banking system historically, the Federal Reserve in banking, investing, bonds, stocks, and financial assets. Basically, focus on money. And this first one is particularly on money. Big questions for this first lesson is, what is money and what are its three uses? Money is a tool for exchange. It's got three specific uses. We'll get into that. What are the 6 characteristics of money? There's 3 that are going to be the focus of this lecture. Okay, money. It has 3 uses. It's a medium of exchange. Anything used to determine value, determine the exchange of goods and services, considered money. Bucks. That originally goes back to buckskins or clams. They used to trade clam shells. I think it was like a quahog shell, and that was used to exchange. Unit of account. It's a means for comparing the value of goods and services. Because $1, $1, $1, $1, £1, etc. And it's a way to store value, something that keeps its value if it is stored rather than used for a bit. If it's years and years, it might decline due to inflation, but mostly it keeps its value. You keep it for a few years. All right. So now we go to the notes. I would suggest you do it side by side like this. If you open up this document and the video next to each other, and then you choose this tab resize button, and you choose the 1x2, and particularly if you see like the slideshow one and the doc one, then it'll be these two. And then it'll work the way you want. All right. Oh, forgot to do something. Once you open this one, you're supposed to make a copy. So you want to do that? I'll do that. And the reason why I'm doing this is so I don't go too fast and make sure it's doable. This would happen when you click that first document, it'll look like this. But then you're like, well, how do I can't get in here. I can't get in here. What do I do? It's no big deal. All you do is find insert and look for the header. That way it's on each and every page, and then you choose header, and it'll pop you right in there. And put your name, date, and it'll actually be on every single page at the top. Overall, it's going to be worth 240 points. Let's use period 3, third period today. To get out, you just click out. All right. The big questions we went over. The first one, the 3 uses, medium of exchange. Account means for. All right. So let's get off that. Comparing. Something that keeps its value if it is stored rather than used. Okay. Let's go to the next one. Coins, characteristic of money. Coins and paper bills are used by a society are called currency. currency. Does it have current value? Way to think of it. Where you have all kinds of different types of money. Coins, bills. A lot of this is American money, but it's not all American money. I see some Canadian bills, see Canada right on this one. And those are not all American coins, but I do see, I think that's a penny. Some of those coins are not just American, though. Currency must meet 6 characteristics. Has to be durable. It has to withstand wear and tear. Has to be portable. Has to be able to be carried with you, so it can't be too big. Um, so durable. I mean, I don't know if you've ever left money in your pocket when you did laundry, but I have. And one thing good to know is even if you leave your money in your pocket and wash it, it doesn't get ruined. That's good. Portability means you can carry it. Divisibility means it can be broken down into smaller units. So if you have $100, you get change. Some places won't even take big currency units. Like 7-Eleven typically won't take $100 bill, that kind of thing, or the gas station. The bank takes it all, so if you got big bills, then you can't break it. You take it into a bank. That's why you generally don't want hundreds, because they're a pain, unless you got a lot of hundreds. It's good. Or you have to spend it for something expensive. Uniform. Any two units of money must be uniform. $1 has to be $1, five, 10, whatever. And they need to be able to buy the same thing. Let's go to the next one. So limited supply. Money must be available only in limited quantities. So basically, they don't just keep printing money, or when they print money, they actually destroy some money. Why? If you have too much money in circulation, it'll devalue the money. You'll create inflation. It's not good. Acceptability. Everyone must be able to exchange the money for goods and services. So, dollar, bread, flour, uh, money for the fruits, vegetables. Everyone needs to be able to make that trade. So, write in the notes, limited quantities, and then everyone needs to take it. Hopefully, this is going good so far. Let's go to the next note. Commodity money. Objects have value in themselves. Gold, cigarettes. This is true whether it's in prison, war, regular times, things with value in and of themselves. Diamonds would be another commodity. Representative money. Money has value because the holder can exchange it for something else of value, whether it's gold, silver, diamonds, stock, bonds, um, the rental housing, food, drink, whatever. It's also called legal tender. It has value because the government is discreet. It may be used to pay for debts. Today's money. If you click on the notes on this tender, you get a pop up here, and you see you'll get Amazon says something about bill genuine legal currency, blah blah blah. I don't know why you want to pay $11 for a dollar, but here's why I did this. On this, you can scroll and look at it closely. See where it says this note is legal tender for all debts, public and private. That means that it's true. It's fiat money. The government has said it's worth it, so it is worth what the government says. However, people only accept this because they agree with the government. If people didn't accept this, they wouldn't take the money. So basically, current money is fiat. It's legal tender because the government says it is, and because people accept its value as such. So it's really money is collective belief that it is worth what we say it is. And the reason why the American dollar is so strong, America's collective belief is really strong. And so, yeah. And if you look at the dollar, I mean, really, it's a piece of paper. And that piece of paper is not like ipso facto, by the fact of it, worth more than a post-it, but it is because we say it is. Here's gold, a commodity, and then you got it. The money is supposed to be valuable because the government says it's valuable. All right, let's go ahead and get to the quiz. What is money and what are its three uses? I'll do the first one, then I'll leave you to the second one. And that's how it'll go from here on out. Money is a tool for exchange, basically. Whether you're storing it, it's still currency. Tool of exchange, I'm going to make a list. It's a medium, count, to compare value. Storage, so it's a tool of exchange. Let me clean that up. It's a tool of exchange used as a medium to compare value and stored value. What are the six characteristics of money? Well, we got them right here. Durability, portability, divisibility, uniformity, limited supply, acceptability. Go ahead and pause while you answer, and then continue pressing play, and then I'll go to the next topic. Okay, the next topic is changes in American banking. The key issue here will be to describe how American banking has changed from its beginning in the founding of the country in the 1700s to the present view of banking. It's going to be a quick overview of banking. Before the Civil War, there are two basic beliefs. One is the federal view and the anti-federalist view. Hamilton represents the federal view, Jefferson, the anti-federalist. The Federalists thought that a strong central bank with a national bank to handle a single currency and federal funds to oversee bank was the way to go. Jefferson really believed in the states having power, and the Anti-Federalists had the states having power over the federal government in terms of controlling banks. This was the main, or at least a key issue distinguishing Federalists and Anti-Federalists. Eventually, the Federalists dominate. That's why Hamilton's a thing today, not Jefferson, even though Jefferson's kind of a big deal too. So let's write in the notes, National Bank. See how being side by side makes it super easier. Single currency. There was a problem like under the old Confederacy, Articles of Confederation, where you'd have to, as you were traveling, you'd have to change your money in each state. It really got crazy. And so people quickly saw how crazy it was. So that led to a lot of support for the Federalist view on money. And we're adding in Hamilton, and we're adding in Jefferson. I like to get rid of the extra blanks. You don't, okay. But it's cleaner if you do. You're going to be able to want to read this cleanly. Let's go to the next one. The first Bank of the United States was created in 1791. and it could collect and hold tax money, issue money, and monitor state banks. Uh, but there was chaos in banking at first, and the first bank loses support, and they lose its charter as to be a bank in 1811. And state banks issued many different currencies, so that was a real problem in early business for America, having too many currencies and not really having a centralized banking plan, because states wanted their autonomy. So they didn't really want a federal bank. So even though there was one at first, it got they got rid of it really early in the history of America and American banking in 1811. So the first bank had some power, tax, told the tax money, issue money, and monitor state banks, but it doesn't survive very long. So, yeah, what are they going to do next? Well, they're going to create another Bank of the United States because you still need to issue money, you still need to collect taxes and whatnot. So they created one in 1816. There was concern that the Supreme Court would say that's unconstitutional, but it temporarily restored economic order. And so people were happy with this. And then there was this period um, where this was free banking era. And the second banking charter expires in 16 years in 1832. And the state controlled banks return. So what returns? Chaos. Or because you didn't have one, you had two, really a lot of money is being controlled by a lot. So just add in the word return and keep going. So what do we have at first? We had one federal bank that didn't last too long, and that had tax money, issued money, and modern state banks. And then you had a second bank, and that calms things down for 16 years. And then you get this period of chaos where the state banks are largely dominant until the Civil War. And in the Civil War, things started to change. There's a National Bank of 1863 and 1864, and the government had the power to charter banks, have banks hold gold and silver reserves, and issue a national currency. Go ahead and take some notes on that. This made business easier because you just had one kind of money to worry about. And it really made sure that the dollar was going to be strong, especially according compared to Confederate banknotes. And so you get what's known as the gold standard, wherein every dollar was backed by an equal amount of gold, some kind of whatever the value of gold was. This meant America really had to hold a lot of gold and silver to support its economy. But this led all people to want American dollars. They knew they could trade it in for gold, and Europeans would come time to time and really try to trade in their dollars for gold. And so, because people preferred gold to dollars, even though gold is much more difficult to transport. So the port because it's heavier. The Federal Reserve Act is created in 1913, and really it's designed to move away from the gold standard. In 1896, William Jennings Bryan, a famous populist from the Populist Party who was associated with farmers, said, "You shall not crucify man on a cross of gold." It was a very famous speech because he said basically that people were more important than gold, and farmers would get destroyed if the gold standard was kept. And so the first move was to go to silver, and then eventually, yeah, money. Money is what it's worth because of what we say, not because of the amount of gold or silver kept in a bank. So basically, in the 20th century, um, the Federalist view really comes into power permanently. And they create what's known as the Federal Reserve System. It's often called the Fed. It's the first true central bank of the United States. In the Banking Act of 1933, there was a response to the Depression because there was these runs on the bank, and they created the Federal Deposit Insurance Corporation. That way, every savings account was insured by the federal government. At first, it's up to 100,000. Now it's like currently like $250,000 for each depositor. So they don't insure all of your money, but they insure a big hunk of it. And so now there's no more gold standard, and U.S. currency is fiat or authoritative money. That's why it says this is legal tender on the bill. And if you click on that again, you'll see that dollar on the Amazon, and you can scroll over it and see the words "This is legal tender." And that's it. All right, let's go ahead and add in those notes. So we're writing in the Fed and FDIC. And we're writing in 250,000. And we're writing in fiat. Fiat means by order. It's an arbitrary or authoritative order. It is what it is because we say it is. So it is. Okay. So now we're on to completing this quiz. And as the other one, you have to write a complete sentence. And you're not to submit today or even right now. So we're about 20 minutes in. This one I'll go over because it's kind of complicated. So let's talk it through. In the 1700s, the First Bank of the U.S. held tax money, oversaw state banks, but quickly lost its charter, led to Second Bank of U.S. early 1800s, which state bank chaos and allowed one currency, but that charter expired 1832. State banks ruled until Civil War, and it began gold standard 1913 Federal Reserve System created, and FDIC was born to protect depositors after Great Depression. Ending gold standard and committing to fiat system. That was a lot. Feel free to slow that down and play it again, but get it all down and press play when you're ready. So I'm going to keep moving. All right. That's the end of the changes in American banking. Should definitely finish that far for day one. I think we'll keep going a little bit longer though. It's about 25 minutes in. We can do another section. What is the Federal Reserve and its role? Okay, so we just kind of hit the tip of the iceberg on the Fed. What's the difference between M1 and M2? Okay, that's about money. assets. The Fed and its role. All right, let's go forward. As stated on the previous slideshow, the Fed is the Federal Reserve System, and it's basically the central bank of the U.S. This is it. The X was because they had a Fed, then they didn't have a Fed, then they had a Fed, they didn't have a Fed, because the first and second banks of the U.S. didn't last. But the Federal Reserve System has lasted and will last. It was created in 1914 to protect banks and citizens from financial panics, or basically runs on the bank, where depositors run to the bank and they try to pull out all their money. And that would happen because you didn't want to go to the bank and be last in line, and all the money and your hard work that you put in there just gets taken because the bank mismanages its money. Let's add panics and runs for notes. Okay. And here you see a map. A map of the different branches of the Federal Reserve System. I'm not sure if this is Federal Reserve System or mints. I know there's a mint in San Francisco, but it looks like branches. Federal Reserve, because I know there's a mint in Denver, even though there's one in Philly. So notice there's a lot more in the Northeast. There's one in Richmond, but there's only one key city that covers each region. All right. The Fed's role. It serves the government. It's the government's banker and agent. It issues the currency. So it works with mint, printing press, to make sure that it's hard to copy American banknotes and coins. That's why there's ridges on the coins and there's watermarks inside the bills. It's really hard to reproduce that just right. But it serves and regulates the banks. It clears checks. It supervises bank practices, and it's a lender of last resort. Notice the American iconography with the bald eagle and the laurel wreath and the stars and stripes. So we go into our notes. So you notice what I'm doing. Just click present when I'm looking at the full thing. When I go to notes, I take it off present mode. And I just do one slide at a time. So I can keep my thoughts from going too fast. I could read it through, then fill in the blanks to see what I can remember. A way to rep it clearly. All right, let's go to the next one. Regulating the money supply. It's important to control the supply of money because when you don't, you can get major problems. Like the Germans post World War One, they owed a lot of money from the Treaty of Versailles, and then to pay off that debt, they just printed money, and so all their money became worthless like automatically. That means no one's really in control, successfully controlling the monetary policy because the economy is destabilized, and so it's not good. So you need some mechanism to control the monetary supply. Usually do that with your interest rate. That's why the prime rate is what people follow. And if you get a better value on a loan, you should take it. That's why the interest has led to a lot of people refinancing their homes lately because it was the lowest interest rate I think I ever seen by like December of 2020. So smart people refinanced, including me. But your target rates are keeping unemployment below 6.5%, keeping gross domestic product growing 2 to 3%, and having a core inflation rate that's not too high. Money today. Money supply is all money available in the U.S. economy. M1, it's all money. The first strand of the money supply is all liquid access assets, easily available, cash, checking accounts, debit cards. M2 is all liquid assets plus savings and money market mutual funds. Credit card is not money; it's a loan. You're borrowing money at an exorbitant interest rate, and if you cannot afford to pay that successfully, it's a mistake to borrow too much. So don't make that mistake. The most college people make that mistake. Don't want that to be you. So write in all. And one is all liquid assets. It means it's easily converts into cash and portable money. It's readily, it doesn't take a long time to change it. M1 is M2 is M1 plus saving. In other words, it's all liquid assets plus savings, money markets generally. So it's liquid plus. Why? Because usually money markets, there's limits on the timing of when you take it out based on what kind of money market. And to be clear, credit card is not money, though some people think equate status with how much um, a line of credit you have. I don't. I did when I was in college, though, because I don't really understand money as well as I do now. As I learned more, I learned that credit was a scam to try to get you in debt, a scam that I no longer fall for. All right, let's go to the next one. How do banks make a profit? Well, banks make a profit by, first of all, loaning money. But the Fed requires banks to keep a fraction of the funds from its customers in reserve. It's called fractional banking. You have to keep some amount. I don't know if it's 10%, but let's assume it's 10%. And then the other 90% they want to have working for them to make money. So they make money on interest, basically. Interest comes back on loans as a bank's greatest source of income. So you keep 10 of your $100 and the other 90 is on loans. And you have liabilities. Interest is the price paid for the borrowed money. All right, let's write that in. Keep a fraction, keep a small percentage of all your funds, customers. Let's keep it all because the more you get in play, the more you can profit. But if you have too much out, then it's destabilizing. That's why they want to keep, like, make you keep a practice. And the interest customers pay on loan, that's where they get most of their money. And interest is price paid on borrowed money. All right, let's go to the next one. Banking services. Banks do a few financial services. They'll allow you to store money. They allow you to save money. They allow you to write checks, pay for things. They let you have credit cards, loans, mortgages. Mortgage is a specific kind of loan just for a house. Other loans are, you could have a car loan, you could have a boat loan, you could have personal loan, business loan, all kinds of loans. Let's write in our notes. Storing money. I guess I want to make a capital. Type on the notes. Credit cards. What else? The other ones? Loans. Mortgage is a loan. I know that's kind of repetitive, but it's a particular kind of loan. That's for a house. Okay. How do the banks make money? Well, they basically get value out of the money they have. They get deposits from their customers, which they get interest on. They take fees for the services. Some people get annoyed by how much too many fees, so they'll keep shopping around. I know I don't really like it when the fees get crazy. Everyone accepts a certain amount of fee for the service, But if the fees are too high, people are going to be just like, I don't want to use you. That's why there's been a larger demand for electronic banking, because they tend to be less fees. Fees are usually associated with paying tellers, business costs. The more you automate things, cheaper it gets. But then you get less personal things, and so when you have problems, you have problems. Okay, money goes out of the bank as the money loaned, but that comes back into your bank through the interest. All right, let's look at that more in particular. Notice what I did that time. I did it in a different order. I think it's okay to vary the order. So this is the money coming in, deposits, fees, interest. Money going out is interest, withdrawals, costs, and loans. But the loans get you the interest. The cost um, get covered but from interest and the fees and deposit. Interest and withdrawals also lead to more deposits, so it's kind of a circular thing. But in this, there's profit, or it stops. Look at the banks. Look at the doggies at the bank. Oh, HSBC. Okay, stored value cards. Okay, these are like gift cards, right? It's a little different than credit cards. Types of financial institutions. There's a few. Commercial banks, savings and loans banks, credit unions, finance companies. Let's stop right there. So commercial banks, those are ones that businesses tend to deal with. Savings and loans are your like B of A, Wells Fargo. And then you have the credit unions, who are usually only accessible through work, but you tend to get a good rate of return on that, good lower fees. You got finance companies. You have electronic banking. This is anything, debit cards, banking online. I don't know how banking online and online banks are different. It's the same thing. Um, anyway, get the idea. The more things are automated, the cheaper the overhead cost. Then you get these automatic clearinghouse and stored value cards. It's another form of banking that's a little bit, and I would think you could add in, uh, can you add in PayPal and Venmo here? I think so. So I'm doing it. And I'm teaching the class, so there you go. And I'm going to get rid of banking online and online banks because I think it's the exact same thing. So I think it's dumb to call it both things. So I'm not going to. That said, I'm grateful for getting these notes from somebody, saving me a ton of work. PayPal. I know Venmo is more popular now. I think people like Venmo because you get to see how other people are spending their money on there. It's fairly secure, even though, and then lots of people use it, so it's convenient. All right, let's go to the quiz, and then we'll call it a day for this. Say that this is it for the day. All right, in complete sense, answer each and open note quiz on your note-taking sheet. This is day one of lecture notes. When all chapter notes are completed, submit to Google Classroom. Do not submit today. What is the Federal Reserve and its role? Federal Reserve is the national bank, and its role is to regulate banking. Regulate the economy. Double check. Our note says Federal Reserve, government lender and agent issuing currency, clears checks, supervise, lender of last result, regulates money supply, stabilizes the economy. Okay. Did I leave anything out? Controlled currency. Its role is to regulate economy. It does that through by setting the loan rate. I'm not going to type in the difference between M1 and M2, but I'll tell you the answer. The difference between M1 and M2 M1 is all liquid assets in the money supply. M2 is all the liquid assets plus savings and money markets accounts. So the difference is M2, I mean, the total is the total money supply. It's not just the liquid assets, it's also harder assets to access, like the savings or money market. They're not, savings is fairly liquid too, but generally you have to move it to checking to spend it or withdraw it somehow. So the cash and checking accounts are more easily converted to ready available funds. All right, so that's the main difference. So go ahead and answer that one, and then let's call it a day. And again, you're going to see this video. It'll be the second video in the assignment, and it'll be the first one highlighted in 6.1 right here. And when you see and you've gotten to the end of this, and day one notes, it'll be in red. That is your goal for day one. I think that'll be plenty. And expect the video to start on the next one. That's it. Hope this video is helpful.